morning, everybody. Pleasure and delight to be here with all of you. I did manage to reach here in one piece after seeing much of Delhi this morning, but it's good to be here. And it's good to be amidst fellow panelists, extremely accomplished group. Right, so here is a bunch of data that my colleagues put up, which says that today, the median valuation of the top 8 listed companies, market cap, is 350 crores, makes them small to mid cap. Now, it's interesting that over the last 5 years, the CNX mid cap index appears to have doubled, so about close to 16% cumulative CAGR. And over the last same period of 5 years, the education stock valuation has halved. Right? It's interesting, right? So everything else is doubled, and we are half. The current median value, PE, is about 13, which is the median PE of the CNX index as a whole. So this is not, appears that it's not being seen as a growth sector, at least by the public markets, investors in the public markets. Going further ahead, the total annual investment in the sector was peaked at about $250 million in 2011, but it dropped to less than half the following year at about 100 million plus, about 110 million. And this year it's been about 50 million YTD. Given that we are close to the end of the year, I will not be too surprised if by the end of the year the total investments made in the sector is less than what happened last year. Right? On the contrary, we did a quick comparison across retail, healthcare and food, and all those sectors which are all consumption driven, thesis, the common thesis being consumption driven, seem to have increased. Right? Now, I just want to put this perspective. Now, there is some disconnect perhaps, and we'd like to examine what the disconnect is. I think that's one of the first lessons that would come out of investing in this sector. On the one hand, there is common acceptance, and I could say, I could see both at the panel and from the audience as a whole when I said that this is a perennial sunrise sector and a sector of a huge interest and potential. I believe so deeply, and I could visually see a lot of acceptance. I know the panelists agree with me, but I could see a lot of nodding of the heads in the audience as well. When that's the case, the markets, at least the public markets, don't seem to be, at least over the last 5 years, don't seem to be demonstrating that. So where is the disconnect? What I would like to do now is to maybe ask Imran to be the first person to get this off. Imran, you among the panelists perhaps has the longest experience and the largest in dollar terms, and certainly the maximum number of transactions from a M&A kind of a perspective, exits and M&A perspective. Given your rich tapestry of experience over the last 5 years, where is this dichotomy? What does this tell you? And do you really think there is a dichotomy at all to start with?
Thank you, Anand. We've been investing consistently in education for the last 9 years. We made our first investment, which is also what we're known for, which is Edicom, in 2005. But we followed that up pretty consistently since then and made 5 other investments. In fact, our largest investment till date across 2 funds was in March 2013, this year, which also happens to be in education, a company called Eurokids. So our perspective, on education is that in 2007, education was perhaps not as exciting as they told you then. And today, it's not as bad as you might think it is. It's somewhere in between. And we've seen this playing out over the last 9 years. We put 50% of our dollars into education. We made our largest investment in education. If you look at our portfolio of education from a fundamental standpoint, our education portfolio has grown, all the companies are growing between 20 to 50% a year on top line. If that stands for what's happening in the education sector, I'd say it's somewhere in the middle. What has slowed down in the education for sure has been the sluggishness in the exit markets. The IPO markets are nearly dead today. The M&A markets are, at 7-year lows and very sluggish. Private equity interest has been waxing and waning for funds that either don't have a strong bias or don't have a focus. Education interest has also, you know, had its peaks and troughs. And if you go outside India and look at the US markets, this phenomenon that you spoke about, which is, you know, that the education index in India has in some way underperformed the other mid-cap index, has played out in the US as well. So if you look at the Dow Jones over the last 7 years, it would have increased by, let's say, 45 to 46%. The Google Education Index rose by less than half, at 18%. So globally, the investor interest in education, it's fair to say, is out of step with the reality we are seeing as long-term investors and as long-term entrepreneurs in education.
Let's just stay with that for a minute, Imran. Quick one. One of the problems is if things are not as exciting as one thought or not as bad as one is, somewhere in between is always a bad thing. You know, it should be on one end of the spectrum, makes things a little easier. But I agree with you. I buy your point that things are not as bad as what they seem. Is it that there is an irrational exuberance that happened maybe a few years back, which kind of therefore lifted everything to ridiculous levels, which in turn translated itself into poor returns today? And are we therefore just seeing a dampening of the oscillation to more sane levels, or perhaps even much lower than what sane levels ought to be? And is that therefore an opportunity, both from an investor and from an entrepreneurial perspective?
So yes and no. So, you know, there was a time when, I'll speak of companies that, you know, I'm familiar with. So Educon was trading at some point at 100 times price to earnings. That's just not sustainable. We weren't complaining because we were investors, we made a lot of money, it was fine. But 100 times price to earnings ratio in any industry at any time is just unsustainable. So to that extent, you know, was there exuberance at some point? Absolutely. Is there a huge opportunity today if you believe that some of that exuberance or a lot of that froth has gone away? Absolutely. So that's one part of it, and I think that's from the investor lens. Some investors will try and manage this dissonance by saying, you know, there's a contrarian opportunity, as if the opportunity did not exist in the past. But that's fine. You know, whatever gets the dollars in. Okay. But I think the biggest conviction for us comes from talking to our entrepreneurs. And you'll listen to Satya this afternoon. And if you spend, you know, 10 minutes with Satya and listen to his story over the last 20 years, that's all you need to know about what is good about education, what the challenges are, and what you need to do, you know, to create value in the space in India. And I'm sure there's several entrepreneurs here. What is very gratifying for us, who have a 20-year view of investing in education with conviction, 20 more years, is the fact that if you talk to young people in their mid-20s and ask them, do you want to start up? A lot of them, an increasing number of them, are saying yes. And two, in which sector would you like to start? An increasing number of them are saying education. So if you're a 20-year investor in education, I draw a lot more comfort. I don't have a problem with the demand side. As you said, it's a perennial sunrise sector. But I think what is really gratifying in the Indian context is the excitement and the entrepreneurial.
You know, many people tell me that the phrase irrational exuberance doesn't apply to investors, because all investors are very rational, right? All investments are very, very rational. So you cannot have irrational exuberance. So you get your point, but the other point you made about the fact that there is such an amount of entrepreneurial interest, young entrepreneurial interest, is absolutely correct. I got the data from NASSCOM is doing a startup programs. You know, the maximum number of interest that has come from startups is actually from the education and tech sector. So that's really reflecting the point that you made. That's a nice segue to you, Sandeep. Now, when you started this fund, you know, you are the largest and the only pure education-focused fund in India, and you have seen the market, and you probably have seen hundreds of deals, if not in the four figures. What has been your experience? You know, the stuff that Imran spoke about. You know, his experiences of actually making money 30x and all of that good stuff. And his commitment that despite whatever is happening, one of the biggest investments or the biggest investment in education is made in March, as recent as March of this year. Is that generally reflecting as you see the marketplace, or what are your views about how this whole thing is panning out? Where do you see it going?
So, I agree with many things that Imran said, and one of the things that few data points which might be interesting. For example, in the last 3 years, we've seen 900 odd companies which have been registered in our database as potential investment opportunities, and at a run rate of about 4 to 8 a week on average. That's quite a few people looking at building their future careers in businesses and education. So there is a groundswell, and increasingly people who built businesses previously in technology and other sectors have migrated towards education. So we agree with that, and the pace is increasing, particularly towards EdTech. Second thing, from our micro portfolio perspective, we have made 6 investments in education so far, and we were looking at, since the date of investment to date, what's been the weighted average growth rate of revenues, for example, of our portfolio companies. It comes to 68%. Now, while there are younger companies, and most of them are around $5 million or $10 million run rate, that is pretty impressive even at that stage for any sector. At the same time, when you look at some of the macro opportunities that are described and that are present in the Indian stock markets, they were macro opportunities in one particular segment of the sector, quite undiversified from just a way to cater. They are very capital focused. So a lot of that might have been exuberance or reflection of the excitement of the people towards education, but the reality is investing is a very micro activity. You might have to follow macro trends to understand where value might be created, but each entrepreneur will view the opportunity differently, will tackle it differently. To us, it's really about thematically seeking opportunities from entrepreneur by entrepreneur, company by company, and then applying our own thesis to it, saying, can we realize returns, the best growth, the best, aligned with the strategy? If that is there, then it becomes interesting enough for us to say, let's dive deeper into it and say, this is a value creation opportunity of the future. Not interesting to look at yet another test preparation company, which is doing yet another IIT preparation ranking for. Not interested in that, because that is yesterday's story to us. While it continues to build big companies and something that we look at, if it brings significant differentiation aligned with our opinion of themes that will drive great growth and good quality in the sector. And alignment of quality and growth are two things which come along and so it's something we discussed today.
Interesting. So, if the takeaway from what Imran said was the fact that things are not as bad as what they seem, and certainly not as exuberant as what they appeared at one point in time, what you're saying is that you really have to look at the entrepreneur in the eye, and you back entrepreneurs, and you believe that this sector has got enough and more young entrepreneurs with differentiated ideas that are coming in. So that's the entrepreneurial dust. You have to go and figure out who's got that. Data also demonstrates that the average median investment size is less than $5 million in the sector. It's really not a PE size. It's earlier than that. Is therefore that a problem as you see it?
I see that's an opportunity, because if you look at historically the returns people have given globally, late VC continues to be an asset class which has done well, at least in the sunrise era of VC. And this is where we can generate an alpha with the companies bringing in processes because of fragmentation, because of lack of quality talent at managerial level. Entrepreneurs might be passionate, might be high quality, but often managerial talent hasn't realized the potential of the sector because ESOPs have not delivered value to managers yet. But being able to define that, being able to create a strong team around an entrepreneur, and being able to build a company can drive alpha for the investors, and therein lies the opportunity at that stage.
So in addition to the entrepreneurs, are you actually seeing enough managers coming into the system? Because entrepreneurs alone are not good enough, because they need to build teams. Are you seeing enough other people, managers from other sectors, very smart people moving in here?
So the good news of it is that there are. The bad news is there's nobody in education that has delivered great quality from a manager perspective, not an entrepreneur perspective, great successes. Few people, not many, but few people. So you really have to hire laterally from other sectors. But the good news is that we often meet people who have built careers and are in their 40s, even 50s, done really well in financial services, really well in IT, for example, and media, and really interested in being on managers of large companies or medium-scale companies in education. So that is beginning to happen, partly very emotional, because this is something I want to do now, and partly because they see there's an opportunity for them to create and drive value where others spend very palatable to a sector and
it's a good thing. The want to do part actually, in my experience, diffuses away in about 6 months' time, and then the reality of working and meeting your goals kind of kicks in. And you're absolutely right about returns. Very few companies have managed to actually give returns to their employees. Investors may have made money wise, but we'll come. This is a larger ecosystem question which I'll come to later. Mohit, let me jump to you from there, which is now you looking at what you heard so far, and if you had an opportunity to invest X dollars in education versus other sectors, where would you place education? What is it that you have seen about the education sector that makes you, perhaps go a bit towards education or the other way around?
Okay, what I'll do is I'll give you two different perspectives. One is my previous engagement at Bearings, where the average ticket size used to be, close to around $35 million. And I think, as my co-panelist rightly said, that the ticket size in education is closer to around 5 to 10 million. So the first fundamental disconnect we had at that time is to look at right opportunity set, considering the regulatory hurdles. Of course, some of the segments like universities and school education, they are fairly decent opportunities given the right regulatory environment. But otherwise, if you look at overall, there are not too many companies that have scaled to $1 billion run rate. See, few pointers maybe just to be on the devil's advocate side and give the other side of the story. More often than not, I have heard revenue-driven valuations in the education sector. More often than not, people come and ask about 10 times sales, 5 times sales, 15 times sales, revenue growing significantly, but I haven't seen too many companies driving high returns. Returns not necessarily for the investor, but returns per se as an intrinsic driver. Because guess what, if the return driver is poor, and if you add the revenue of top 5 companies in India in the education space, even though the sector is perhaps $70–80 billion, the top 5 companies don't even contribute $1 billion. Now, so if that's the kind of fragmentation, which means poor entry barriers and not necessarily high return drivers, and then most companies end up saturating closer to around 100 to 200 CR kind of top line. I'm talking outside of schooling again. It becomes a great deterrent to drive returns or look at investments from a top-down perspective. Now, when I say top-down perspective, I think interestingly another observation, the fact that if you look at areas of wealth creation in India, among the top 3, one of the biggest one has been the IT/ITS hubs, and hence the lot of first-generation entrepreneurs in the IT segment today, the Silicon Valley of India, primarily happened because of ESOPs-driven wealth creation, and that's not necessarily happened for education as a sector. Or even if you talk about banking, a lot of people make money. I remember having invested in financial services closer to 50 to 100 million transaction size. It was really difficult in mid for higher ticket size. A, there are not too many options. B, not too many companies have demonstrated exitability. Not necessarily for the investor, but for the employees at large. C, I think the fragmentation has perhaps ensured that again not too many companies are big enough. Larger ones are struggling to grow and drive profitability. What scares me from a bigger company set perspective is even at large scale companies are not necessarily profitable. Having said that, the other side of the story, so that's the larger ticket size issue. The beauty about the sector is, I think it's a fairly old sector, but it's fairly nascent. The fact that the average Indian age is 27 years, please look at it as, or compare it to the baby boomers of 1960s in US. There is tremendous opportunity, like Imran rightly pointed out, for the next 20 years. And hence the late VC concept, wherein ticket sizes of $5 to $10 million, specifically in segments like employability. Employability to us is a great opportunity. There are not too many success stories, but I think the sector has tremendous potential. Technology-enabled, initiatives, both from online, offline perspective, because there is tremendous opportunity to look at tapping customer base in a cost-effective manner through online routes. Continue to deliver to offline methods. Just I'll bring an example in another sector, right? So there can be a lot of such situations and opportunities in the education space. We are seeing them. We have invested in child skill development in the current fund, and we believe that again child skill development is a great, I think, again Europe is something very similar, even though the segment's different. So broadly I would say that from next 10 to 15 years perspective, $5 to $10 million ticket sizes, companies that are perhaps $4 to $5 million in revenue run rate, but who can grow faster, maybe to up to $50–60 million. These are sweet spots for late VCs and smaller ticket size B investors. But broadly, if you look at $250 million plus kind of funds, it's really difficult to look at and identify macro opportunities unless perhaps government does something on the university side, opens up regulations and enable investors to explore opportunities in this space.
Interesting. Let me just take that one point quickly and ask you. So you're talking about I heard you say next 10 to 15 years. You're talking about ticket sizes, which is the 5 to 10 million range. Now, anybody would say that that is too long a time for a sector to remain before it becomes reasonably mature. So some kind of a positive churn needs to be created. My limited experience suggests that waiting for the government to do something like that is waiting for Godot. It's simply not going to happen. What is the positive churn that can be brought in, which you think will help push the ticket size up? You will still have young companies. I think young companies are the backbone of any sector, anywhere, anytime. But you still need the larger companies and larger transactions to bring in maturity and substance and momentum.
Okay, very interesting. Let me say a little different angle, give it a different angle to it. If I look at 2007 onwards, we have been of a belief architecture that 2007 to 2016 will be seen as a lost decade from growth perspective in the Indian context. Now, I'm not talking about education as a sector, but I remember we used to laugh about it when some of our colleagues used to talk about lost decade. And here we are sitting in looking at 2014. It's been 7 years. So the context of growth capital-driven returns, which the entire private equity industry has been, talking about for the last 12 years, and I've been in a fund again which started in '99. Trust me, it's not going to happen because growth capital won't drive 25% compounding. In that context, what we like is a multiple-driven strategy. Now, again, people will say invest at lower P and exit at higher P. By the way, that doesn't happen because to me, it's a greater fool theory. But the concept of dividend payout, if you look at European market in last 2 years, in spite of the European crisis, lot of blue chips have given dramatic returns, primarily because dividend yields are closer to 7–8%. You look at banks like HDFC Bank or ITCs of the world, they continue to drive higher valuations, primarily because these companies have been tremendous dividend payout companies. Private equity as a concept doesn't look at dividend payout, but if you look at segments like child skill development, perhaps even test prep, where the return drivers and ROEs are fairly high, but the growth potential is limited, I think private equity investors perhaps can look at dividend as a way of driving returns. We have done that with one company. I can give an example. Company which is in media education space, current one we have. This year it's paid dividend of 15%. The company's been growing at 50% compounded. It has negative working capital. I can put in another $5 million, but you know what? They have no way to utilize it. The cash yield distributions become more favorable. I think there are opportunities in this space. Where just look at another angle. If you look at the labor productivity of India, it's pathetic. It's not about education as a sector, but last 4–5 years, the labor productivity actually has dropped. And hence, to me, private equity funds, if they can drive the labor productivity in education-oriented companies, I think the returns are going to be far higher. It's important for entrepreneurs to start looking at returns, to start making profits rather than just driving top lines.
So P's have to start looking at dividend as a return rather than multiple. That's like telling a South Indian, stop drinking coffee, have a chamomile tea or something instead. It's going to be very difficult for them to accept it. That's an interesting thought. But I have a point on the fragmentation part. I'll come to that later. But I really want to pick the thread from what you said. You heard all of this, and I want to bring in a completely different perspective. You invest in social enterprises. At one level, I believe very strongly, in all the panelists who agree with me, that education is about making a difference to the society, the community that it impacts, to the students and therefore to society. And therefore, I would suspect, if one were to not be very strict about the definition of the term social enterprise, at least the way it's used now, all education entities are social enterprises in one sense. And then the regulatory structure of India is based on the education policy, Indian education policy, which says that education is for social good. Now you have heard all the aspects which are essentially investor-led. What are the conversations you have heard so far is investor-led. You're an investor as well, but for you it's a social enterprise. What kind of a, are there nuanced changes that you see? To what extent do you really see that impacting the way that you look at the education sector in India? And is there a substantial difference between the way that you would look as an investor in social enterprises and you believe that other late VC, early PE, doesn't matter, other classical investors?
Sure, thanks Anand. Yeah, I think there's two real differences, and we're slightly different beasts from my colleagues on the panel in that we're a social investor, as you pointed out. Our capital is primarily philanthropic, which means that we can take greater risks and we also have appetite for longer time frames. So I think one of the issues that came up on the panel, and I look forward to discussing later in Q&A, is the question of kind of quality and outcomes. And we feel that those have much longer kind of gestation periods than lend themselves to quicker or faster exits. And I think the second issue which you brought up is the issue of what constitutes kind of social outcomes in education. And one is, of course, education itself is a social business, quite like healthcare. But the other, especially for us in India, is really the extension of or the access to education for lower income markets. And just to kind of point out the scale and the size of the problem, as you know, there's about 10 to 15 lakh children turning 15 every month for the next 20 years or so. As Mohit pointed out, this is a kind of a demographic dividend, but if you actually look at the outcomes that the system is producing today in terms of learning, we may be headed for a demographic disaster. And the ASA results that came out earlier this year suggest that reading levels for standard 5 children have actually dropped. 46% of standard 5 children 3 years ago could not read a standard 2 text, and today that number has gone up to 53%. And the results are even worse for math. So that number was 29% of standard 5 children could not do a 2-digit subtraction 3 years ago. That number has also gone up to about 50%. So what we're producing is really 10 to 15 lakh children every year entering the workforce who don't have basic literacy or numeracy. And of course the government has been putting in a lot of effort into vocational training and education, but despite that the outcomes have been decreasing. So I think from our perspective we're looking at how do we take some of the learnings that have come from the mass or the higher end of the market, extend them towards sustainable education at the lower end of the market, while returning our capital, but over a longer time frame producing outcomes for lower income customers. And I think there's really 3 or 4 challenges that need to be solved that make this very, very difficult. One is that the gestation period between intervention and outcome is just so long. So to give you an example, we also look at investing in Pakistan and East Africa. And one of the companies that we were looking at in Pakistan is a company called Sufi Foundation, which has 8 or 10 schools in rural Punjab. They charge their customers about 2,000 Pakistani rupees a month, which is equivalent to about 1,000 Indian rupees a month, which in rural India for private school is very, very high. Typically private schools in rural India charge about 300 rupees a month. And so my question to Sufi Saab was, how do you get parents to actually pay you such a large amount of money? And his response, which still kind of has stayed with me, is that it actually took 10 to 15 years to make that happen. And the reason it took 10 to 15 years is that they do things that we would want to do, like teacher training and ongoing assessments and so on. However, for the parents in that district, in Hafsabad district, they had been putting their kids into government schools decade after decade and not seeing any results in terms of the employment outcomes for those kids after they graduate. Over time, they started putting their kids into private schools and still didn't see any employment or learning outcomes for the kids who they put into private schools. And so the parents started to believe that while education was something that you did because people demanded you to do it and society demanded you to do it, there was really no distinction between public and private, and really no distinction in quality of education. And it was only until the kids from these schools started graduating, going to cities, getting jobs, going to college, coming back, even teaching at their schools, that they started to understand that there was a difference between education at Sufi schools and education at other private or public schools. So this is a direct result of a second challenge that we need to solve, which is the difficulty of measuring results in education. Today we don't have a set of data-based kind of accountable standards to which we hold not only our schools but also our teachers to. And then the third issue is the ability of parents to actually pay for this, which is a combination of 1 and 2, which lends itself to much more kind of tangible spends in education. So we see a lot of spend in kind of IT, in supplementary services like science and math, but much less spend in training. So for a parent who is already paying kind of 1,000 rupees a month to charge them an extra 100 rupees for some kind of teacher training for which you're not going to see the results for another 5 to 10 years, and is certainly not a tangible thing, is a very, very large ask. And so the question is, how do you drive quality into the system when most of the demand is focused on kind of tangible spend? And certainly in the higher end of the market, we've seen that with large sort of sections of the market dedicated to kind of IT and tech in education, which at the lower end of the market, given infrastructure, electricity, internet, and so on, just doesn't exist. And then just the last point is that, what we find is that the public sector kind of just dominates education at the lower end of the market. And so how do we actually create, as we spoke about yesterday, the infrastructure for innovation that will allow some of these ideas to scale, whether through the public sector or through the private or through the non-profit.
So the lessons, as you say, one is the time that you have with the patient's capital that you need to invest has to be much longer than it would be for others. The second that I'm hearing from you is that there are a lot of opportunities for innovation. It's like a bottle that's being filled up with pebbles and then in sand, and then you pour water and you still find. So innovation is like that, and the entrepreneurs need to bring that innovation. I think those are the 2 points. The point that you made about the 100 rupees extra for teachers training, it's always much easier to spend on a bowl of ice cream than to invest in, fitness and exercise, where the results are going to take a much longer time. And that's the unfortunate situation. So one would rather buy a 3,000 rupee tablet than pay 100 rupees extra for teacher training. That's the issue. It's been a pleasure. Thank you very much.